Picture Sarah, a 34-year-old teacher in Ohio. She checks her 401k maybe twice a year. Last Friday, June 12th at 9:50 a.m. Eastern, Sarah became a SpaceX investor. She didn't click buy. Nobody called her. There's no confirmation email. But if Sarah owns a target date fund or any broad market index, and statistically, she does the orders already processing. Or take Marcus, a software engineer in Austin who's been religiously dollar cost averaging into Triple Q for 5 years. Marcus thinks he avoided the SpaceX hype by not buying on Friday. He's wrong. Within weeks, somewhere between 0.5% and 0.7% of his entire Triple Q position will automatically convert to SpaceX shares at whatever price the mechanics demand. This isn't conspiracy. It's how index funds work when rule changes collide with the largest IPO in history. Let me show you exactly what's happening to your money. Here's what changed, and when, on May 1st, 2025, just 6 weeks before SpaceX's IPO Nasdaq officially rewrote their index inclusion methodology. The old rule required newly public companies to wait at least 3 months before entering the Nasdaq 100. That buffer existed for good reason. It gave markets time to find a stock's real price without billions in forced buying distorting everything. The new rule? Companies ranked in the top 40 by market cap can now enter after just 15 trading days. 3 months became 15 days. The safety buffer evaporated. But here's the part that should make you pause. They also eliminated the minimum free float requirement entirely for these fast entry candidates. Let me explain why that matters using actual numbers. SpaceX went public Friday at $135 per share. It opened at $150, peaked at $176.52, and closed at $160.95. By closing bell, SpaceX was worth approximately $2.1 trillion, the sixth largest U.S. public company. Now here's the critical detail most people miss. SpaceX has 12.9 billion total shares. The IPO sold just 555 million, that's barely 4% of the company. The remaining 96% is locked up with Elon Musk, employees, and venture capital firms. At Friday's closing price, that tiny 4% slice is worth about $89 billion. That's the entire tradable float, every share actually available to buy and sell right now for America's sixth largest public company. Think of it like this. Imagine Jennifer owns a house appraised at $500,000, but she's only willing to sell one bathroom worth maybe $20,000. That's the proportion we're dealing with. Now imagine the entire neighborhood is legally required to buy pieces of that bathroom in the next 3 weeks. What happens to the price? Let's count the dollars, because this is where theory becomes your retirement account. There's currently $527 billion in ETFs tracking the Nasdaq 100. The massive Triple Q fund alone holds nearly $500 billion. When SpaceX enters at the expected 0.5% to 0.00, 7% weighting, here's the math, 0.5% of $527 billion, $2.6 billion in mandatory, buying 0.7% of $527 billion, $3.7 billion in mandatory buying. That's just the Nasdaq 100 ETFs. Now add Russell 1000 funds, which are actually larger. Add institutional products. Add active managers who track these benchmarks and can't afford tracking error falling behind because they don't own what their benchmark owns. It kills their bonuses. Bloomberg Intelligence calculated that index funds will need to absorb roughly 24% of SpaceX's public float, When you include active managers benchmarked to these indexes, the total exceeds 50% of all available shares. Read that again. More than half the shares you could buy today will be pulled off the market by funds with no choice in the matter. That's $7 billion to $27 billion of forced demand hitting an $89 billion pool of actual shares starting around July 6th. Here's the calendar Sarah and Marcus need to understand. June 12th, SpaceX IPO July 2nd, first day eligible for Nasdaq 115. Trading days after listing, July 6th expected inclusion date, the Monday, after late June/early July index funds begin buying ahead of inclusion. August 21st, first insider lockup expires 7% of locked shares. Released. Following 9 weeks, 4 more lockup tranches release another 28%. See the pattern? The forced buying wave peaks in early July. Then, starting late August, insider supply floods the market, the exact opposite pressure. If this sounds theoretical, we've seen this movie before. On November 16th, 2020, Tesla was added to the S&P 500. From announcement to inclusion, December 21st, Tesla jumped approximately 40%. Index funds had to buy $80 billion of Tesla stock to match the index weighting. That mechanical demand lifted prices before they could even complete their buying. But here's what's different with SpaceX. Tesla had traded publicly for years with deep liquidity and a much larger percentage of shares available. Tesla entered the S&P 500 at 1.69% weighting, with maybe 80% of shares freely tradable. SpaceX is entering at 0.7% weighting, with just 4% freely tradable. Per dollar of forced demand, SpaceX has dramatically less float to absorb it. The mechanics are the same. The pressure is exponentially higher. Let me identify the 4 groups in this trade. Group 1, the insiders, Elon Musk, early employees, venture firms who bought shares at pennies or single-digit valuations years ago. They sell into unlocks starting August 21st after the forced buying lifts prices. Clear winners. Group 2, the bankers, underwriters who earn fees on the IPO and participate as market makers. They designed this mechanism. They're paid regardless. Group 3, the active buyers, people like David, who bought SPCX Friday at $161 because he believes in the Mars mission. David made a conscious choice. He owns the risk and the potential reward. If the 20-year vision plays out, he might do fine. Group 4, the passive holders, Sarah with her 401k, Marcus with his triple Q. They didn't choose this. They're paying the inclusion premium without making any decision. Same trade as David, probably worse price, on someone else's timeline. Let's make this practical. If you hold triple Q or triple QM, you'll own SpaceX at inclusion weight within 3-4 weeks, at the post-announcement price spike. You won't be asked. It'll just appear in holdings. If you hold Russell 1000 ETFs, IWB, IWF, etc., same situation on the FTSE Russell timeline. If you hold VTI, it tracks the CRSP Total Market Index. SpaceX enters on their schedule slightly different timeline, but same outcome. If you hold VOO, S&P 500, here's the important exception. The S&P 500 didn't change its rules. They require positive earnings in the most recent quarter and across 4 quarters combined. SpaceX is currently losing about $4 billion per quarter. You're not getting forced SpaceX exposure through VOO, at least not until profitability. That decision deserves recognition. Not every index played this game. Over the weekend, Elon tweeted that SpaceX might reach $1 trillion in revenue by 2030, definitely by 2031. SpaceX's 2025 revenue, $18. $7 billion to reach $1 trillion in 5 years requires a compound annual growth rate of approximately 122% for 5 consecutive years. For context, Apple's best 5-year stretch, nay 26% CAGR Amazon's best 5-year stretch, nay 30% CAGR Musk's projection, implies roughly 4x the fastest sustained revenue growth any megacap has ever achieved. You don't have to dismiss it, but you also don't have to pay for that belief this week at mechanically inflated prices. Bad idea #1. Try to opt out of passive exposure. Most 401k participants can't. You don't control individual holdings. Switching funds means selling at one bad price to buy at another. Bad idea #2. Front run the inclusion by buying SPCX now to ride the wave. This is the smart money play that circulates on Twitter. It rarely works. With Tesla, most gains came before announcement, not after. Front runners usually hold the bag when mechanics finish and prices revert. The quiet third path. Acknowledge your passive exposure is coming. Don't add active exposure on top of it. Don't compound a forced position with a chosen one. Let the next 6 months unfold the buying wave, the unlock schedule, the first earnings under public scrutiny, then reassess when price reflects actual business reality instead of index arithmetic. The most valuable advantage investors have isn't secret information. It's willingness to read the information that already exists. The Nasdaq methodology document is public. The deleted float requirement is documented. FTSE Russell's parallel rules are on their website. Bloomberg's estimates are published. The Tesla case study is in every financial archive. None of it is secret. Almost none of it made headlines this week. That habit-reading mechanics before headlines is what separates investors who understand what's happening from those who only see the price move. Whether Sarah ever learns about index inclusion mechanics, whether Marcus figures out why his triple Q suddenly holds SpaceX, the rules are being written. They don't ask permission. The most expensive habit is avoiding this information. The cheapest is starting to read it today. See you next time.